going to start off by talking about oil price. Before I even introduce myself, that's the elephant in the room for an oilfield service company. Should our share price be tracking down with the oil price? And let's give you a case for it not happening. Complicated question. Everybody in the oilfield sector suffers when the oil price goes down. Nobody's immune. It just depends how immune you are. KBC is a consulting and technology company in the oilfield sector, and we focus very much on operational excellence, how to get more out of what you've got. And in a converse way, as the oil price comes down off of large highs, we tend to do better, because the oil industry needs our services to do better with what they've got. They come off of exploration in upstream first, and they focus very much on production, which is where we're based. KBC's history is very much in refining, and refining is further immune and second to go when the oil price comes down, because as you know, the gasoline price doesn't go down at the pump very quickly, but the feedstock costs go down. So refining tends to do well in a small drop in oil price. So far from a KBC perspective, we're not seeing an adverse effect on our business yet, and I know that would have been the first question that I would have asked if I was sat there. That brings us into what KBC is, who we are. So my name's Andrew Howell, CEO designate. I run the technology group at present. Ian Gordon's our executive chairman, and Andrew Head is our CFO, both here as well, so we can talk afterwards if you want to. KBC, not to be confused with KBR, who are a much bigger company than us. KBC, the initials of the three founders. ESSO, or Exxon Research, folks out of London, 30 years ago, saw an opportunity for a consulting company to go after helping second-tier oil companies, national oil companies, with the kinds of things that Exxon instilled in them in the industry. Set up in Weybridge, just down the road from here, and we're still in Morton-on-Thames headquarters. What do we do? Well, what we do is profit improvement in hydrocarbons. So we take a look at the hydrocarbon value chain, so the plastics we were talking about a few moments ago about petrochemicals, into refining and up into the upstream sector. We look at the whole oil field sector, and we look at how operators can make more money, more margin, be more reliable, more safe in their operations. Our key to KBC is we employ a lot of people like myself. I'm a degree-educated chemical engineer, spent a lot of time drilling wells in the jungle around the world, lived in 17 countries during my career, and we have 350 folks just like that, with a background in refining, background in mechanical engineering and compression systems, background in upstream oil and gas, well flow, well design, etc. And we go to work and we act and we think like operators. So we work for national oil companies, multi-international companies, second-tier independents. We think like them, they trust us. We deliver both consulting and technology to improve their throughputs. Established in 1979, went public in 1997, AIM listed, headquarters in Walton. Revenues last year of roughly 65 million, and by forecasts that you've got in front of you, pushing through the 70 million this year. Key to KBC's success, and the reason we're still around 30 years later, is our internationalisation. Very early on, the K, the B and the C parted ways in the company. One went to Singapore, one went to Houston via New Orleans, and one stayed in Walton. So with three very strong hubs in engineering, oil and gas centres around the world. And that's placed us in a very good stance to open other satellite offices around them. We're now in 18 offices with 10 what we call geomarkets. So USA, Canada is one geomarket. South America is another geomarket. We need that footprint. That footprint's important. You've got to be in the local oil and gas centres. You've got to talk the language. You've got to understand the local business. Every oil field is different. Different in constitution, different in chemistry, different in location, different in language. So you have to have that presence in as many places as you can, which is a stretch for a small company like us, but we've optimised that over the last few years. What do we offer? First and foremost, consulting. We started as a consulting company. We offer people to the industry that know how to optimise a refinery. We've built out technology and tools, so know-how from consulting and physical simulation software that we sell to the industry. So we've advanced ourselves on the technology side, and I've been on board for 4 years running that technology division with a laser focus on more high-quality software sales and recurring MSU to the industry, containing our knowledge from the consulting group. And then, of course, we have methodologies. 30 years in the business, working in most refineries around the world, most upstream gas plants around the world. We've developed methodologies on how to improve things, how to train the people, how to optimize the assets. And we sell a combination of those things. And when we sell all of those together, we sell bigger engagements. In terms of the biggest we've ever done, 2012 December, we announced a $100 million US 4-year engagement with Petro-Ecuador, which was essentially to work on the Esmeralda refinery north of Quito to improve its performance from bottom quartile upwards over the next few years, working to train their operators, identify opportunities to improve production in the refinery, make sure there's no safety issues, and train management on what crudes to process. Refinery is a very complicated beast. We'll talk about those in a few seconds. So people, software tools, methodologies for the oil and gas business, very strong in refining, expanding into upstream. Our vision is really the most innovative technology company spanning the hydrocarbon value chain. We're not going to get into cement or food or power or paper. Largely, absolutely 100% in the hydrocarbon value chain. And we look at solving our clients' toughest problems from their point of view, thinking like them as an operator. And that differentiates us from many competitors. You won't see a competitor slide in this deck. There's too many of them. From industrial automation companies through to oilfield service companies through to Accentures and McKinsey's. We blend our technology, our people, and our methodologies together in a very unique way, and in fact, often work for many of those competitors in a sub-license scenario. Brand recognition survey came back. The clients really do think we're quite innovative, the way we've paired technology with consulting. Definitely driven. We have a reputation for getting the job done, and we do it honestly in a lot of very harsh environments around the world. Let's take a few moments to think about the market and look at the oil and gas business as a whole. We started off in refining. Refining is a very complicated market. Each refinery has many different, if not infinite, different combinations of what crude oil do you put through it, how much distillation do you use, how much steam do you put into it, how much reactor time do you use. So a refinery is split into two parts. You have the distillation at the front end that takes off the easy stuff, and then the heavy stuff goes through a series of reactors. Very expensive, vanadium catalyst type equipment that then upgrades the heavy oil in the presence of hydrogen to form gasoline or synthetic jet fuel, things like that. Now, depending on what equipment you have, what crude oil you've got access to, the markets for your refined products, you can configure that refinery to operate in many different ways. And that's the advice that we give to the industry. Each and every geomarket around the world has its own microcosm, has its own climate. For instance, in the mid-west of the US, mid-continent, 74 refineries from West Texas up through to southern Canada, all now able to process shale oil. That shale oil costs $15 a barrel because it has nowhere to go. And the Keystone XL pipeline was turned down again yesterday. Stranded shale oil sold cheaply to those refineries, but it comes at a price, never a free lunch. Shale oil is full of paraffins. It waxes up the units, which damages them long term. So KBC involved with many of those independent refiners, such as Valero, Irving, Tesoro, in the Midwest there, on how to get shale oil through the refineries, blend it with heavy Canadian crude, and produce products at the same Henry Hub, the same New York prices, but with cheaper feedstocks. So that's proven a great fertile ground for us. We took a decision a few years ago, and I come from the upstream, I'm from the oilfield services side of the business and upstream. We took a decision to really try and expand our services and our technology into the upstream oil and gas market. A natural hedge against changes in downstream, and also a lot of our services and software are relevant in upstream, and as we know from the picture there, and as we know in general, upstream is about 10 times the size of downstream in capital expenditure. Okay? Volatility in both of those markets, a great opportunity for KBC. The shale oil revolution, for example, with our refiners in North America. Just to recap our offerings. So, first of all, I'll start in the middle. Heritage Technical Process Consulting. So, looking at a refinery, looking at its configuration, advising a refiner such as Valero or Exxon or BP, turn up the pressure there, turn down the temperature, process Canadian crude instead of Venezuelan crude. That kind of advice we've been doing for over 30 years now. And we developed a lot of good reputation and IP and knowledge there around things like reliability and maintenance, safety, yield, and so on. We've captured a lot of that and built it into our software technology. So think flight simulator for a refinery. We sell something called Petro-SIM, which I'm going to show in a few moments, which captures a lot of our knowledge in a commercially available software platform. It simulates that refinery. If I want to switch crude oil from Canadian to Venezuelan, what have I got to do to the refinery? How much steam or more energy am I going to consume by using a different crude oil? Do I still make money? Do I still make the margin on the barrel? And finally, at the bottom, one of our biggest growing areas in recent years is the people side of it, business transformation. We did a lot of work for South American refiners, national oil companies, Petrobras in Brazil, Pemex in Mexico. We often recommended a lot of changes to their refinery, changes to their configuration, and discovered they couldn't do it. They couldn't push it through, so they didn't have the people or the processes or the knowledge to execute it locally. So we bought a business transformation and organizational type company out of Denver about 10 years ago, which has grown tremendously in KBC by taking that technical recommendations and working with operators to make the changes and realize the benefits. The Ecuador contract I mentioned, 2012, is a culmination of selling all three parts of that KBC value chain. And obviously our strategy is to continue to sell bigger jobs, anchoring those three business lines together, and pushing the mix of technology, recurable MSU for software up, as well as expanding upstream. You have a history there. I'm not going to go through all the points, but our history is a typical journey of a consulting company that attempts to become a software company, messes it up a few times, and then starts to get it right. And that's the summary of us. Along the way, to differentiate yourself, you buy a number of acquisitions. I mentioned the organizational acquisition. We acquired an energy engineering modeling technology from a UMIST spin-off a few years ago. We've acquired Infochem in 2012, which is a London-based, very unique production chemistry simulation software, spin-off from Imperial College. And just this summer, we'll talk about it in a few moments, we acquired FEESA out of Farnborough, another Imperial College spin-off that does well bores and pipelines, particularly subsea offshore. And from BP's Macondo Gulf of Mexico issue, you know how important modelling those offshore infrastructures are in terms of safety, reliability, etc. We developed technology. We have roughly 40 software programmers based in Calgary, which is the assembly plant, if you like, software office. It creates Petro-SIM, the platform, the simulator. Our reactor technology, very unique in the industry, acquired off Honeywell 10 years ago, developed and built into Petro-SIM, so you can model the entire refinery, including all these very specific reactors. Reactor technology out of Houston. Houston is a centre for reactor and refining technology. Northwich is the UMIS spin-off for energy I talked about. And I mentioned London, the PVT chemistry from Infochem, and finally the recent acquisition of FEESA with their product called Maximus that models wells and flow lines. So 5 technology centres worldwide. One thing we've done over the last few years is put a process, a proper, rational, unified, agile development process in for the software development. We've become night and day to where we were before in terms of professional software development. And we've begun that journey of capturing a lot of our consulting knowledge and implementing it inside of the technology. The consulting group in KBC, 2 consulting groups, technical and organisational, our biggest sales channel. They deal with C-level people in refining, C-level in the hydrocarbon supply chain and upstream. Fabulous sales channel for our technology. And it's that uniqueness of the 2 things together that makes KBC very different. Here's a picture of Petro-SIM. This is Petro-SIM production. It's the upstream flavour. Think offshore, think platform of the technology. We released version 5 late last year. It has ribbon bars. It's Microsoft Fluent design. Whether you like ribbon bars or not, they're here to stay. Our younger engineers love them, me not so much, but we are modern, we are touchscreen, we do integrate with Excel at the touch of a button, and we've really modernised our software platform to A, make our own consulting division more efficient, and B, sell against our competitors out there with more modern technology moving faster. We introduced, you can't really tell from the graph, but this is very unique. It's patented in the industry. We filed 3 patents with this technology in 2013. It's the time bit at the bottom here, going from 2014 out to 2018. All of our competitors, and traditionally, modelling an oil platform, an offshore platform, oil refinery, is done at one time. You do it today and you play with it, and then you build another model for next year and another model for the year after. Well, we took the ability to create one model that runs over 5, 10, 15, 20 years into our simulation technology. So what this is telling us is this is compressor power. This thing up here is a little bit of lesson in engineering. Hannah told me not to walk too far from it. That's a compressor. That sits on the offshore platform. It's essentially a jet engine. It's analogous to the jet engine on the side of an aircraft, and it basically takes the gas in, compresses it to high pressure to get it to shore. That compressor might cost you $20, $30 million to buy, $10 million to run. You can only afford one. You have only got the space for one offshore. If you break it, the platform's offline. If you've got non-availability in your offshore systems, that's where the margin erodes dramatically in production efficiency. Got to keep that compressor running. Got to keep it running well. The problem is, over here, the reservoir side is depressuring. So the reservoir, as we pull the fluid out, the pressure's going down. So logic says that that compressor has to work harder in future years to get the gas to us at our homes. And eventually, it's not going to work anymore. And you make a decision on, do I buy a new compressor or do I shut the whole thing down and walk away? The one thing you can't do is buy a compressor on day one that lasts 20 years, because you buy too big a compressor, operate it inefficiently at the start, and only get the gains at the end. So offshore engineering is a real game of weight, space limitations, time and uncertainty. And essentially what Petro-SIM is telling you here is that just at the end of 2016, early 2017, you need a different compressor. The power requirement's going up, and if you drop it with a new, bigger machine, you're going to make more money, actually. You get more throughput, more efficiency on the machine, less energy to run it. Time-based simulation for upstream. We have the same thing in downstream. Traditionally, we come from the refining world. This is a distillate hydrotreater. So it takes heavy oil, heavy crude oil off the bottom of the crude distillation unit. It smashes it with hydrogen at high pressure under vanadium. It removes sulfur and some other contaminants and cracks that heavy oil back to gasoline blends, synthetic gasoline. But essentially, what happens is the oil scales up the catalyst. So if you just switch it on day one, within about 3 or 4 months, the thing has deteriorated. After 6 months, it's in trouble, and after a year, it won't produce any synthetic gasoline. You have to clean it. The question is, when do you clean it, and when do you recharge the catalyst? Because that means taking that unit offline in the refinery for about 3 weeks. Petro-SIM is the first simulator that can not only do the entire throughput of the refinery, but it can track the temperature. That's the outlet temperature of the oil. As that increases, it's telling you that the system's becoming more inefficient. And in fact, it's at this point right here after the roll in about August of last year, we needed to replace the catalyst in that unit. That, again, is patented technology. Time-based, workflow-based simulation in both downstream and upstream. I talked about upstream, and I talked about the offshore compressor sitting on top of the platform. In refining, we can do the whole refinery. In upstream, we've only been able to do the platform itself, not the pipelines coming in and out, and not the wells themselves. And obviously, if we want to offer a complete optimization solution to the upstream industry, the wells and the pipelines are as important, if not more important, than the facilities themselves, the separation facilities themselves. So we looked around the market for a number of things. One, the chemistry of the reservoir. That was Infochem, acquisition in 2012. We've managed to treble the revenue from Infochem. It's met our targets. It's been a great acquisition. Opened up customers in oilfield service companies like Schlumberger that we never had before. But we needed the pipelines and the wells in order to complete that chemistry journey through our own facility simulator, Petro-SIM. And so we bought FEESA, a Farnborough-based, UK-based company from our share raise that Hannah, equity raise that Hannah mentioned before, 11.2 million with 1 million in shares. And that, as I said, enables us to look at the whole spectrum of hydrocarbon from start to finish. That integration is going well. We've got quite good at integrating niche technology companies, putting them into our own sales channel. The kind of companies we like are deep IP, many patents, not much of a sales channel worldwide, because we want to put it into our own, and a small lean office infrastructure. And a spin-off of academia is always good, and obviously software technology, or heavy in software versus consulting, and that's exactly what FEESA were. On track to deliver expectations for the second half of this year, which after acquisition. That's a picture of its simulation interface. There's the reservoir connected through the wells. These are the wellhead or Christmas tree valves, as they're called in the industry. Pipeline network up into the platform. And of course, the brown bit on top is what Petro-SIM does. It's the jet engine I showed you just a few moments ago. So now we have the unique opportunity in the industry, the only process simulation company that can take the wellbore, the pipeline, and the surface facility and put the whole thing together, which is an analogous of what we've been doing in refining for the last 30 years. So in summary, we're moving our business model and skills in refining into the upstream business. Just a few notes on performance. I'm going to spend too much time on it, and we'll open it for questions. What we've managed to do on our journey in the last few years is sell more technology, increase technology in the mix. That's a main part of our strategy going forward. We've more than doubled our visibility on quality revenue going forward, and that'll be well past 8 million by the end of this year. And that's a big focus for us, long-term rateable revenue contracts with everybody in upstream and downstream oil. Adjusted profit before tax, flat for a number of years. The new management team back in 2011 really focused on reshaping the company, closing a number of offices down, opening some in upstream centres like Kuala Lumpur, and focusing on the sales and support of the technology whilst ensuring consulting margins were on target and growing as we needed them to. We saw a great response to that in the PBT in 2013, and you've got a prediction of the journey in the broker's notes, in the analyst's notes. But so far, so good in the last couple of years. Share price doing very well up until the AIM slide and up until the oil price slide. Hence my attempt to decouple us from at least the oil price at the start of the presentation. Doing everything we can again to make numbers this year, show a further increase in technology revenue, and return to profitable growth in the share price. Last numbers we released were the first half in September. Revenue's up 9%. Profit before tax, if you take out foreign exchange movements, up about 64%, but we did get hit quite heavy with foreign exchange in the first US dollar. A lot of our international oil customers force us, we have to take contracts in US dollars. And so we are a little bit dependent on that. We are hedged a little bit in terms of the number of countries we operate in, but we are affected by exchange rate. Exchange rate, of course, has come back in the second half of the year, so we're hoping for some positive reinforcement of exchange rate in H2. Net cash 24.4 million. You have to take another 10 million out of that because we bought FEESA in July. That's the June number. So, but still fairly strong balance sheet there. Technology revenue was down 13% year on year. You can see 2013 was a record year, or record half year, for software revenue. Reason being, we had a number of big contracts early in 2013, one with an Exxon affiliate called Tone & General in Japan in January 2013. That's a bit atypical. Most of our large software contracts happen in the second half of the year, and in particular in Q4 quite often. That's the buying patterns of the oil industry from a technology perspective. But we did quite well. We got pretty close in H1 of 2014. And in particular, we announced a $5.7 million software deal with a South American major in the second week of July. So it just slipped over into July. Second half, as we reported, has been strong, and we're largely in line with analyst and broker expectations for 2014 in both consulting and software technology. We focus very much on pricing, utilization and leverage, the three key things that you can do for a consulting business. It's not easy to run a consulting and software company. They have very different needs, both on working capital, both on capital investment. But we've done a fairly good job, we think, of the last few years of getting a handle on them and getting the synergy of both of them together, working in both refining and upstream. And as we reported at the half year, our pipeline is very strong for both consulting and technology, and we haven't seen an erosion as yet due to the oil price, hence the statement at the start of the presentation.